I once lost thousands of dollars in the stock market because I thought I was smarter than everyone else. It was during a particularly volatile period, and I was convinced I could predict the dips and rises. I'd frantically watch the news, scour financial forums, and try to sell before a perceived drop, only to watch the market rebound days later. Then I'd buy back in, usually higher than where I sold, chasing the upward trend. This emotional roller coaster was exhausting and ultimately deeply expensive. I was trying to time the market, believing I could outsmart its unpredictable nature. And like countless others, I learned the hard way that it's a fool's errand. If you've ever felt that impulse, that pull to try and make a quick buck, or the panic to sell when everyone else is, believe me, you are not alone. It's a completely natural human response to want to control things, especially our money. But when it comes to investing, one of the most powerful, yet often overlooked principles is that time in the market consistently beats timing the market. It's a simple concept that, once understood, can profoundly change your financial future. Today, we're going to dive into why this principle is so incredibly powerful and how embracing it can bring you closer to your financial goals with less stress and more confidence. Let's get into the top reasons why consistency and patience are your best allies in investing. Here's what most people miss when they try to time the market, and it's the bedrock of all wealth building. 1. The unstoppable power of compounding. This is perhaps the single most important concept in all of investing. Compounding is essentially earning returns on your initial investment and on the accumulated returns from previous periods. Think of it like a snowball rolling down a hill. The longer it rolls, the more snow it picks up, growing at an accelerating rate. Your money makes money, and then that money makes more money. Let's look at a concrete example. If you invested $200 a month consistently for 30 years, assuming a modest 8% average annual return, which is actually lower than the historical average for the S&P 500 over long periods, you would have personally contributed $72,000. But thanks to the magic of compounding, your investment could grow to be well over $270,000. That's nearly $200,000 in growth you didn't earn from your labor. It was earned by your money simply staying invested and doing its thing. If you try to time the market, taking money out and putting it back in, you interrupt this powerful compounding process, severely limiting your long-term growth. 2. The futility of predicting the future. Nobody, and I mean nobody, can consistently predict the short-term movements of the stock market. Not the fancy analysts on TV, not the gurus with their secret formulas, and certainly not me when I was trying to time my buys and sells. The market is influenced by countless factors: economic data, global events, company news, investor sentiment, geopolitical shifts, many of which are completely unpredictable. If it were possible to consistently buy low and sell high, everyone would be doing it, and everyone would be a millionaire. Trying to time the market implies you know something the collective wisdom of millions of investors and sophisticated algorithms doesn't. It's a high-stakes guessing game where the house always wins in the long run. Even the most renowned financial experts often admit that their predictions are just educated guesses. By staying invested for the long term, you take the guesswork out of the equation. But this next point, this truly shocked me when I first saw the data. 3. Missing the best days can devastate your returns. This is where the true cost of trying to time the market becomes startlingly clear. Market gains don't happen smoothly. They often occur in sharp, unpredictable bursts, and if you're out of the market during even a handful of these best days, your long-term returns can be drastically impacted. A Fidelity study found that if an investor missed just the 10 best days in the S&P 500 over a 40-year period, 1980 to 2020, their returns could be cut in half. Think about that. 10 days out of thousands. It's virtually impossible to predict when these best days will occur. Often, they happen right after a major market dip, when fear is at its highest and many people are tempted to sell or stay out. By simply staying invested through thick and thin, you ensure you're present for those crucial growth days, preventing you from accidentally leaving a significant portion of your potential wealth on the table. 4. Emotional traps. fear and greed. Our emotions are powerful, and while they serve us well in many aspects of life, they can be detrimental to our investing success. The impulse to time the market is often driven by two primary emotions: greed and fear. Greed tempts us to chase hot stocks or new trends, buying high because of FOMO, fear of missing out. Fear, on the other hand, compels us to sell when the market drops, locking in losses and preventing us from participating in the inevitable recovery. I know this firsthand from my own disastrous attempts at timing. When the market dipped, my gut screamed, "Sell," and I listened. I sold low, only to watch it climb back up months later. This cycle of buying high and selling low is a wealth destroyer. A long-term, time-in-the-market strategy helps to remove these destructive emotions from your investing decisions. By setting a plan and sticking to it, you develop the discipline to ride out the market's natural volatility, rather than letting your emotions dictate your actions. The simplicity and effectiveness of dollar-cost averaging. One of the most practical ways to embrace time in the market is through a strategy called dollar-cost averaging. This simply means investing a fixed amount of money at regular intervals, regardless of what the market is doing. For example, investing $100 every 2 weeks into a diversified index fund. Why is this so effective? When prices are high, your fixed investment buys fewer shares. When prices are low, like during a market dip, your same fixed investment buys more shares. Over time, this averages your purchase price and reduces your overall risk, preventing you from putting all your money in at a market peak. It automates the process, removes emotional decision-making, and perfectly embodies the set-it-and-forget-it philosophy of long-term investing. It's a powerful, low-stress strategy that consistently rewards patience. And finally, here's the ultimate reassurance, a truth baked into decades of market history. Now, habit 6, historical resilience and growth. Finally, and perhaps most reassuringly, is the undeniable historical truth. The stock market, despite its inevitable ups and downs, has always recovered and grown over the long term. If you look at a chart of the S&P 500 over the last 50, 70, or even 100 years, you'll see corrections, bear markets, and severe crashes. But each time, the market has not only recovered, but gone on to reach new highs. These downturns, while scary in the moment, are often buying opportunities for long-term investors. They are a natural part of the market cycle, not a signal to abandon ship. By keeping your money invested, you're betting on the enduring power of human innovation, economic growth, and the overall upward trajectory of the global economy. This perspective allows you to view market dips not as emergencies, but as temporary discounts on your future wealth. So what does all of this mean for you? It means that the most reliable path to building wealth through investing isn't about being smart enough to predict the market. It's about being disciplined enough to stay in the market. It's about patience, consistency, and embracing the power of compound interest over time. My early mistake cost me not just money, but a lot of anxiety and regret. Learning to trust the process, to simply keep investing consistently, has been one of the most liberating and wealth-building shifts I've ever made. Now, I want to be very clear about something important. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making financial decisions, as your personal situation and goals are unique. But if you're ready to take action today, here's my clear, actionable takeaway. Start investing now, even if it's a small amount. Don't wait for the perfect time or try to predict the next market move. Set up automated contributions to a diversified, low-cost index fund or ETF. This ensures you're consistently putting money into the market, taking advantage of dollar-cost averaging, and letting the power of compounding work its magic over the long term. Consistency, not timing, is your superpower in investing. If this video helped you understand the power of time in the market, please hit that like button, subscribe to the channel for more empathetic personal finance guidance, and ring the notification bell so you don't miss our next video. And tell me in the comments below, have you ever tried to time the market? And what was your experience? I'd love to hear your stories. Thanks for watching, and I'll see you next time.